If your income ends the moment you stop working, then you are not truly free. You are simply getting by. Day after day, people wake up before sunrise, push through long hours, come home exhausted, and repeat the same cycle again. But imagine this: creating something once and getting paid from it for the rest of your life. Not just for a short period, not just until retirement, for as long as you live. That is the core of this message. How to build assets that pay you forever is more than a title. It is the turning point your life has been waiting for. In the next few minutes, you'll learn how to step out of the trap of trading hours for income and begin building assets, systems, products, investments that continue to earn for you while you sleep, travel, spend time with the people you love, or focus on your true purpose. You don't need wealth to begin. You need clarity, the right mindset, and a strategy you can trust. If you're done running after money and ready to build wealth that stands the test of time, stay with this. These may be the most valuable 10 minutes you ever choose to invest.
Chapter 1: The New Rules of Modern Wealth. There's a moment that comes to everyone. Maybe it happened to you last week, or last year, or it's happening right now as you listen to these words. It's the moment when you realize that no matter how hard you work, no matter how many hours you put in, you're still running in place. You're trading time for money, and time is the one thing you can never get back. The alarm goes off, you drag yourself out of bed, you commute, you work, you come home exhausted. And somewhere deep inside, a voice whispers, "There has to be another way." Here's the truth they don't teach you in school. The rules of wealth have completely changed, and most people are still playing by the old playbook. For decades, the formula was simple. Get a good education, find a stable job, work your way up the ladder. Save 10% of your paycheck, retire at 65. That path worked for your grandparents. It might have even worked for your parents, but it's dying right before our eyes. The world shifted while we weren't looking. Technology didn't just change how we communicate or shop or entertain ourselves. It fundamentally transformed the architecture of wealth creation itself. The old currency was labor. The new currency is ownership. The old game was climbing the ladder. The new game is building the ladder and letting others climb it while you collect the toll. Think about the wealthiest people you know, not just the celebrities or tech billionaires, but the people in your own network who seem to have cracked the code. What do they have in common? They don't trade hours for dollars. They own things that generate money while they sleep, while they travel, while they spend time with family. They've built systems, created assets, established streams of income that flow whether they show up or not. This isn't about getting rich quick or chasing some fantasy lifestyle. This is about understanding a fundamental shift in how wealth actually works in the 21st century. Your salary, no matter how impressive it looks on paper, is a trap. It's a golden cage that keeps you dependent, vulnerable, and perpetually one layoff away from financial chaos. Meanwhile, assets, real assets that produce cash flow, are the foundation of true financial freedom. The pandemic revealed this truth in the harshest way possible. Millions of people discovered overnight that their job security was an illusion. But others, those who had built asset portfolios, who owned rental properties or digital businesses or automated income streams, weathered the storm or even thrived during it. The difference wasn't luck, it was structure. It was understanding that in the modern economy, you're either building assets or you're being used as an asset by someone else in their system. Here's what makes this moment in history so powerful. The barriers to asset creation have never been lower. You don't need massive capital anymore. You don't need family connections or prestigious degrees. What you need is knowledge, strategy, and the willingness to think differently than everyone around you. The tools are here. The platforms exist. The opportunity is massive. But you have to recognize that the old rules are dead, and playing by them will only lead you further into the trap. The new rules are elegant in their simplicity. Build things that pay you repeatedly. Create value once, monetize it infinitely. Use leverage, technology, and systems to multiply your impact without multiplying your effort. Stop selling your time and start selling solutions, access, and transformation. This is how modern wealth is built, and this is the path we're about to walk together. 7 key points to take action. 1. Recognize that trading time for money has a built-in ceiling that limits your potential wealth accumulation. 2. Understand that the wealth-building rules have fundamentally changed with technology and globalization. 3. Identify whether you're currently building assets or serving as someone else's asset in their system. 4. Acknowledge that job security is increasingly an illusion in the modern volatile economy. 5. Realize that barriers to asset creation are lower now than at any point in history. 6. Shift your focus from earning a higher salary to building systems that generate passive income. 7. Commit to learning the new rules of wealth before investing more years in outdated strategies. Chapter 2. What truly counts as an asset and what doesn't. You've been lied to about assets, not maliciously perhaps, but the confusion around what actually qualifies as an asset has kept millions of people trapped in financial mediocrity. They think they're building wealth when they're actually accumulating expensive liabilities. They feel rich on paper while their bank account tells a different story every single month. The distinction between real assets and fake ones is the difference between freedom and financial bondage. Let's start with the simplest definition that most people never quite grasp. An asset is anything that puts money in your pocket on a regular basis without requiring your active labor. Notice what's not in that definition. It doesn't say anything that has value. It doesn't say anything you own. It says anything that generates cash flow. This distinction changes everything. Your house, the one you live in, the one you're so proud of, the one you call your biggest investment, it's not an asset. It's a liability. Every month it demands mortgage payments, property taxes, insurance, maintenance, and utilities. It takes money out of your pocket. Yes, it might appreciate over time. Yes, you might sell it for a profit decades from now. But until that moment, it's consuming your wealth, not creating it. A rental property that generates more income than its expenses, that's an asset. Your primary residence, that's a place to live, and there's nothing wrong with that. But let's stop pretending it's building your wealth. Your car depreciates the moment you drive it off the lot. It requires insurance, fuel, repairs, and registration fees. It takes money from you every single month. That's the definition of a liability, not an asset. But a vehicle used in a business that generates more revenue than its total costs, now we're talking about an asset. Context matters, function matters, cash flow, is the only metric that truly counts. Here's where it gets interesting. Real assets come in forms most people never consider. A website that generates advertising revenue while you sleep is an asset. An online course you created once that sells automatically through a platform is an asset. A patent or trademark that produces licensing fees is an asset. A portfolio of dividend-paying stocks that deposits money into your account quarterly is an asset. A profitable business with systems that operate without your daily involvement is an asset. Notice the pattern? They all produce income without consuming your time. Digital assets have become the most powerful wealth generators of our era because they scale infinitely with minimal additional cost increases. Create a digital product once, sell it 10,000 times. Build an audience once, monetize it through multiple streams indefinitely. Write valuable content once, let it generate traffic and revenue for years. The marginal cost of serving one more customer approaches zero, which means the profit potential approaches infinite. But here's the trap that catches even sophisticated investors. Some things masquerade as assets, but are actually speculation dressed up in fancy clothes. A stock you're hoping will go up in price, but pays no dividend? That's speculation, not an asset. Cryptocurrency you're holding for potential future value? Speculation. Raw land that generates no income while you pay taxes on it? Liability. Gold bars in a safe deposit box? Store of value perhaps, but not an asset in the cash flow sense. They might be part of a diversified strategy, but don't confuse them with things that actually pay you. The psychology shift required here is profound. You have to train yourself to ask one question about everything you consider buying or investing in. Will this put money in my pocket every month, or will it take money out? If the answer is unclear, you're probably looking at a liability. The wealthy think in cash flow. The middle class thinks in net worth. The poor think in paychecks. Where you focus determines where you end up. Understanding this distinction is liberating because it completely reframes your financial decisions. Suddenly, you're not impressed by someone's expensive car or big house. You're curious about their monthly cash flow. You're not chasing status symbols, you're building income streams. You're not asking how much something costs, you're asking how much it pays. This is the lens through which every financial decision should be filtered from this moment forward. 7 key points to take action. 1. Define assets by cash flow generation, not by ownership, value, or potential appreciation alone. 2. Recognize that your primary residence is typically a liability consuming monthly cash flow despite potential appreciation. 3. Evaluate every purchase by asking whether it will put money in your pocket or take money out. 4. Prioritize building digital assets that can scale infinitely with minimal additional cost per customer. 5. Distinguish between genuine assets and speculation disguised as investment opportunities. 6. Stop measuring wealth by net worth alone and start tracking monthly passive cash flow instead. 7. Audit your current possessions to identify what you thought were assets but are actually liabilities. Chapter 3. The Millionaire Mindset. Thinking in cash flow, not salary. There's an invisible wall that separates the wealthy from everyone else. And it's not made of money. It's made of thought patterns. 2 people can have the same education, the same starting capital, even the same opportunities, and one will build lasting wealth while the other stays perpetually broke. The difference isn't intelligence or luck. It's the operating system running in their mind. It's whether they think like an employee or an owner. It's whether they measure success in paychecks or in cash flow. Most people have been programmed since childhood to think in terms of salary. What do you want to be when you grow up? How much does that job pay? What's your starting salary? What's the raise structure? The entire framework is built around trading time for money in a linear relationship. Work 40 hours, get paid for 40 hours. Want to make more? Work more hours or get a raise. But there are only so many hours, and raises have limits. This mental model has a ceiling built into its foundation. The millionaire mindset operates on completely different logic. It asks, how can I create value once and get paid for it repeatedly? How can I build a system that generates income without my constant presence? How can I leverage technology, other people's time or capital to multiply my impact? Instead of thinking in hours and wages, they think in streams and systems. Instead of asking for a raise, they ask how to buy or build another asset. This shift feels uncomfortable at first because it requires you to see yourself differently. Employees think, I need security, benefits, a steady paycheck. Owners think, I need skills, systems, and assets that produce cash flow. Employees ask, what's the job worth? Owners ask, what's the business worth? Employees save money. Owners invest money into things that multiply it. The employee mentality seeks to minimize risk. The owner mentality seeks to maximize opportunity while managing risk intelligently. Here's where the psychology gets fascinating. Most people experience anxiety about money because they have one income stream, their job, and if that disappears, everything collapses. Their entire financial life balances on a single point of failure. People with the millionaire mindset feel progressively more secure as they add more income streams, not because they're working more, but because they're building redundancy into their financial architecture. Lose one stream, they still have 5 others flowing. That's not just financial security, that's psychological freedom. The cash flow thinker looks at every dollar differently. Instead of seeing money as something to spend or save, they see it as seed capital. Every $1,000 is a potential down payment on a rental property, the starting capital for a digital business, the investment in a skill that will pay dividends for decades. They delay gratification not because they're miserable, but because they understand compound growth. They know that the coffee money invested today becomes real estate income tomorrow. They're playing a different game with different rules and different rewards. This mindset also changes how you value your time. If you make $50 an hour at your job, that feels like good money. But if you spend 10 hours building a digital product that then generates $50 a week for the next 5 years, you've just earned $13,000 from that initial 10-hour investment. That's $1,300 per hour of effective compensation. Suddenly, your time calculation changes. Suddenly, trading hours for dollars feels like the worst deal imaginable. The transformation happens when you stop seeing yourself as a worker and start seeing yourself as a wealth-building enterprise. You're not just a person with a job. You're a corporation with multiple divisions, each designed to generate revenue. Your skills are products. Your knowledge is intellectual property. Your networks are distribution channels. Your investments are acquisitions. You become the CEO of your own financial future. And CEOs don't think in salaries. They think in equity, cash flow, and asset appreciation. People with employee mindsets wait for someone to give them opportunity. People with owner mindsets create opportunity. Employees ask permission. Owners ask forgiveness. Employees optimize for job security. Owners optimize for option value. Employees fear change. Owners leverage change. The mindset determines the strategy, and the strategy determines the outcome. You can't build millionaire results with employee thinking. The math simply doesn't work. Take action. 7 key points. 1. Replace salary-based thinking with cash flow-based thinking in all financial decisions and planning. 2. Shift your identity from employee to owner, even while working a traditional job. 3. View every dollar as seed capital for future income streams rather than just spending money. 4. Build multiple income streams to create financial redundancy and psychological security. 5. Calculate the lifetime value of time invested in asset creation versus hourly wage work. 6. See yourself as a wealth-building enterprise with multiple divisions generating revenue. 7. Stop waiting for permission or opportunity and start creating both through ownership thinking. Chapter 4. Digital assets, the most powerful wealth tools of the 21st century. We're living through the greatest wealth transfer in human history, and most people don't even realize it's happening. Physical assets built the fortunes of the past. Land barons, oil tycoons, manufacturing magnates. They needed massive capital, physical infrastructure, and armies of workers. But digital assets have democratized wealth creation in ways that would have seemed impossible just 20 years ago. A person with a laptop and an internet connection now has more wealth-building potential than a factory owner had in 1950. The question is whether you're going to recognize this moment or let it pass you by. Digital assets operate on fundamentally different economics than physical ones. Build a physical product, and you need raw materials, manufacturing, inventory, warehousing, and shipping for every single unit. Build a digital product once, a course, an ebook, a software tool, a template, and you can sell it infinitely with almost zero marginal cost. Serve one customer or 1 million customers with essentially the same infrastructure. This is leverage at a scale that previous generations couldn't have imagined. This is how ordinary people build extraordinary wealth in compressed timeframes. Your knowledge is the raw material, and the internet is the factory. Everything you know how to do, every problem you've solved, every skill you've mastered can be packaged into digital products that generate income while you sleep. The expert gardener creates an online course. The graphic designer sells templates. The business consultant records their methodology into a membership site. The fitness coach builds an app. The writer publishes ebooks. Each one is creating an asset that works independently of their physical presence. Each one is cloning their expertise and selling it at scale. Content itself has become one of the most undervalued assets in existence. A well-crafted blog post can generate traffic and revenue for years. A YouTube video can continue attracting views and advertising money indefinitely. A podcast episode becomes a permanent part of your media library, discovered by new audiences years after you recorded it. This is compound interest applied to content. Created once, benefit from it repeatedly. Most people understand this intellectually, but fail to execute on it because they're still stuck in the hourly wage mindset. They can't see how today's content becomes tomorrow's cash flow. Websites and digital platforms are the real estate of the modern era, except they're infinitely more scalable and require a fraction of the capital. A niche website generating $2,000 per month in advertising and affiliate revenue might sell for $60,000 to $70,000. Build 3 of them, and you've created a $200,000 asset portfolio from your laptop. Automate the content creation and management, and you've built something that operates almost entirely without you. This is the new version of owning rental properties, except the tenant is the internet, and the rent is paid in traffic and conversions. Intellectual property has always been valuable, but digital distribution has made it accessible to everyone. Write a book, and it sits in a warehouse, requiring printing and shipping. Write an ebook, and it distributes globally in seconds with zero fulfillment cost. Create a piece of software, and it can be downloaded millions of times with the same infrastructure. Register a trademark for a digital brand and license it internationally through online agreements. The friction has been removed from intellectual property monetization, which means the returns are limited only by the size of your audience and the value of your offering. Automation and artificial intelligence are force multipliers for digital assets. Email sequences that nurture leads automatically. Chatbots that handle customer service. Algorithms that optimize ad spending. Tools that schedule content across platforms. Sales funnels that convert visitors without human intervention. Every piece of automation you add to a digital asset increases its value while decreasing the time you spend managing it. You're building a machine that prints money, and technology is making the machine more efficient every single month. The beauty of digital assets is their stackability. Each one you build adds to your total cash flow without subtracting from the others. 5 digital products earning $500 each creates $2,500 in monthly income. Unlike a job where you can only do one thing at a time, digital assets run in parallel. They don't compete with each other, they compound with each other. The 10th asset you build is easier than the first because you've learned the systems, refined the processes, and developed the skills. You're not just building wealth, you're building a wealth generation capability that accelerates over time. The people who will dominate the next decade economically are the ones who recognize this moment. Physical assets still matter. Traditional investments still have value. But digital assets are the frontier where speed, scale, and leverage create opportunities that simply don't exist elsewhere. You don't need permission, you don't need investors, you don't need a business degree. You need skills, creativity, and the willingness to build something that outlives your active involvement. The tools are here, the platforms exist. The question is whether you're ready to use them. 7 key points to take action. 1. Recognize that digital assets allow infinite scaling with near zero marginal cost per additional customer. 2. Package your existing knowledge and skills into digital products that can be sold repeatedly. 3. Create content consistently, understanding that each piece becomes a long-term traffic and revenue asset. 4. Build niche websites or platforms that generate passive income through advertising and affiliate partnerships. 5. Leverage automation tools to increase the efficiency and reduce the management time of digital assets. 6. Understand that digital assets stack and compound, allowing multiple parallel income streams simultaneously. 7. Start building at least one digital asset immediately rather than waiting for perfect conditions or complete knowledge.
Chapter 5. Building income streams that work while you sleep. The moment you understand that money can be made while you sleep, everything changes. Not because you're lazy or trying to avoid work, but because you finally grasp the mathematics of freedom. There are only 24 hours in a day. If your income requires your active presence for every dollar earned, you've capped your potential at whatever you can physically accomplish in those hours. But when you build systems that generate income independent of your time, you've broken through the ceiling. You've discovered the secret that separates the wealthy from the perpetually busy. Passive income isn't really passive. That's the first myth we need to destroy. Building an income stream that operates automatically requires significant upfront effort. You're creating the infrastructure, developing the systems, establishing the processes, building the audience, and solving the problems. This isn't about getting something for nothing. It's about doing the hard work once so you can benefit from it repeatedly. It's about building a machine that continues producing after the initial construction is complete. The wealthy understand this. They front-load the effort to backload the rewards. The most powerful income streams share common characteristics. They solve real problems for specific audiences. They operate through automated systems that don't require constant oversight. They scale efficiently as demand increases. They generate predictable, recurring revenue rather than one-time transactions. They become more valuable over time as they accumulate data, reputation, and optimization. When you're evaluating potential income streams, use these criteria as your filter. If an opportunity fails on multiple counts, it's probably not worth your limited time and capital. Subscription models have become the gold standard for automated income because they transform one-time buyers into ongoing revenue sources. A software service charging $30 per month generates $360 per year per customer. Acquire 100 customers, and you've built a $36,000 annual revenue stream. The key is that renewal happens automatically. You're not reselling every month. You're providing ongoing value that justifies the continued payment. This is why the wealthiest software companies focus obsessively on monthly recurring revenue. It's predictable, it compounds, and it creates enterprise value far beyond simple profit. Digital marketplaces and platforms create income through transaction fees, advertising, or membership access. Once established, they generate revenue every time users interact, buy, sell, or consume content. You're building the infrastructure and letting the ecosystem generate the activity. A niche job board for a specific industry, a marketplace connecting freelancers with clients in a specialized field, a membership community with premium resources and networking. Each transaction produces a small fee, but volume turns small fees into substantial income. The platform works around the clock, matching supply with demand while you focus on growth and optimization. Affiliate and referral income streams leverage other people's products to generate commission. You're not creating the product, handling fulfillment, or managing customer service. You're creating the bridge between audience and solution. A YouTube channel reviewing products, a blog comparing services in a specific category, an email newsletter recommending tools to a professional audience. The infrastructure is content creation and audience building. The monetization is commissions on purchases made through your recommendations. It's not the highest margin business model, but it's one of the fastest to start and easiest to scale because you're using existing products and platforms. Licensing and royalties turn intellectual property into perpetual income. Create something once, license it repeatedly. Write a book and collect royalties on every sale. Compose music and earn royalties every time it's played. Develop a software component and license it to other developers. Create design assets and sell licenses for commercial use. Trademark a brand and license it to manufacturers. The initial creation requires time and skill, but the licensing structure means you're paid again and again for that single creative effort. This is how artists, inventors, and creators build income that continues long after the work is complete. The critical insight is diversification across multiple streams. One stream is fragile. 5 streams is resilient. 10 streams is anti-fragile. If one dries up, you hardly notice because the others continue flowing. You're building financial redundancy that creates real security, the kind that doesn't depend on a boss's decision or a company's performance. Each stream might be modest individually, but collectively they create the monthly cash flow that funds your life without requiring your hourly presence. This is the architecture of freedom, built one automated system at a time. Most people never start because they're overwhelmed by the options or intimidated by the technical aspects. The truth is simpler than they imagine. Pick one model that aligns with your skills and interests, build it properly, optimize it until it runs smoothly, then replicate the process with a second stream. You don't need to build 10 streams simultaneously. You need to build one, learn the principles, and apply them repeatedly. The first stream is the hardest because you're learning the game. Every subsequent stream becomes easier because you understand the patterns. Start with one, then add another, then add another. That's
how automated wealth is actually built. Takeaways for action. Key points. 1. Accept that building passive income requires significant upfront effort but delivers ongoing rewards. 2. Focus on income streams with recurring revenue models rather than one-time transactions. 3. Build systems that solve real problems for specific audiences through automated delivery. 4. Diversify across multiple income streams to create financial redundancy and resilience. 5. Start with one income stream model, master it completely, then replicate the process with others. 6. Evaluate opportunities based on scalability, automation potential, and recurring revenue structure. 7. Understand that passive income isn't truly passive, but rather front-loaded effort for back-loaded rewards. Chapter 6. Turning your skills into high-value assets. You're sitting on a gold mine, and you don't even know it. Every skill you've developed, every problem you've solved, every lesson you've learned the hard way has commercial value. But most people never monetize their expertise because they think it's common, unremarkable, or not worth paying for. Meanwhile, someone somewhere is desperately trying to solve the exact problem you've already mastered. They would gladly pay for your knowledge if only they knew it existed and could access it in the right format. The gap between your expertise and their need is where assets are born. The mistake most people make is thinking their skills only have value in an employment context. You're a skilled project manager, so you get a project management job. You're a talented designer, so you work for a design agency. You're an excellent teacher, so you teach at a school. But employment is the lowest value application of your skills because you're trading time for money at retail prices. Your employer then packages your work and sells it at wholesale rates, capturing the margin. But what if you kept that margin? What if you packaged your own expertise and sold it directly to the people who need it? Information products are the most direct translation of skill into asset. Everything you know how to do can be taught, and teaching can be packaged digitally. Create an online course teaching your core competency. Write an ebook documenting your methodology. Develop templates that embody your process. Record video tutorials walking through your approach step by step. Build a membership site where people pay monthly to access your ongoing expertise. Each of these products captures your knowledge in a format that can be sold repeatedly without additional labor. You're cloning yourself and selling access to the clone. Consulting and coaching services can be productized into scalable assets. Instead of trading hours for dollars with individual clients, create group programs where you deliver the same content to multiple people simultaneously. Instead of custom solutions every time, develop frameworks and methodologies that can be applied across clients with minimal customization. Instead of real-time availability, create recorded trainings, implementation guides, and automated support systems. You're systematizing your service delivery so that it scales beyond your personal time constraints. The first 10 clients might require hands-on attention. The next 100 operate through your systems. Specialized tools and software turn your problem-solving expertise into automated solutions. You've developed a spreadsheet that calculates something complex? Turn it into a web application and charge a subscription. You've created a process that improves efficiency. Build a software tool that automates it and sell licenses. You've designed a system that solves a common problem, package it as a platform, and charge for access. The most valuable assets solve painful problems automatically. If you've solved a problem manually, there's probably a way to automate that solution and sell it to everyone else facing the same challenge. Your reputation itself is an asset that generates opportunity. Build authority in a specific niche, and doors open automatically. Speaking engagements that pay 5 figures, partnership opportunities with established companies, media appearances that amplify your reach, joint venture possibilities with other experts. A strong reputation attracts opportunity without you needing to chase it. But reputation isn't built through self-promotion. It's built through consistent value delivery in public spaces. Content creation, community participation, problem-solving, and generosity create the reputation that becomes the asset that generates the opportunities that create the wealth. Service businesses can be transformed into asset-based businesses through team building and systemization. You're the only person who can deliver the service initially, but can you hire someone and train them to deliver it at 80% of your quality? Now you have leverage. Can you document the process so thoroughly that multiple people can execute it consistently? Now you have scalability. Can you build systems that handle client acquisition, onboarding, delivery, and support without requiring your personal involvement? Now you have an asset. The business operates whether you show up or not, and that's when it transitions from self-employment to true ownership. The transformation happens when you stop seeing yourself as a skilled laborer and start seeing yourself as an intellectual property developer. Every project you complete, every problem you solve, every system you build, ask yourself, how can this become a product? How can this methodology be packaged? How can this solution be automated? How can this knowledge be monetized repeatedly? That mindset shift turns your daily work into asset development. You're not longer just completing tasks, you're building components of your wealth machine. Your career becomes research and development for your future passive income streams. The beauty of skill-based assets is that they compound with your growing expertise. The more experienced you become, the more valuable your knowledge products. The more problems you solve, the more tools you can build. The more clients you serve, the more refined your methodologies. Time working in your field isn't just earning you a paycheck, it's increasing the value of every asset you create from that experience. This is how consultants retire wealthy, not from their consulting fees, but from the courses, books, software, and systems they built by packaging everything they learned along the way. Target: 7 key points to take action. 1. Recognize that every skill you possess has commercial value beyond traditional employment. 2. Package your expertise into information products that can be sold repeatedly without additional labor. 3. Transform one-on-one services into group programs, frameworks, and scalable delivery systems. 4. Build software tools or automated solutions that solve problems you currently solve manually. 5. Develop your reputation as a niche authority, which itself becomes an opportunity-generating asset. 6. Systematize and delegate service delivery to transform self-employment into a true asset-based business. 7. Approach every project as potential research and development for future passive income products. Chapter 7. The Cash Flow Portfolio: Real Estate, Digital Brands, and Smart Investments. Putting all your eggs in one basket is a strategy for people who love anxiety and vulnerability. The wealthy don't just build income streams, they build portfolios, diversified collections of assets that generate cash flow from multiple sources across different categories. When one sector struggles, others compensate. When one stream slows, others accelerate. This isn't just smart risk management, it's the architecture of unshakable financial security. It's how you build wealth that survives economic cycles, technological disruption, and the inevitable changes that come with time. Real estate remains one of the most reliable cash flow generators in history because everyone needs shelter and space. Rental properties that produce monthly income after expenses are true assets in the purest sense. Buy a property for $300,000 with a mortgage payment of $1,500 per month. Rent it for $2,500 per month. After taxes, insurance, and maintenance reserves, you're netting positive cash flow every single month while a tenant pays down your mortgage. Over time, you gain equity through appreciation and debt reduction. Meanwhile, the monthly cash flow contributes to your living expenses without requiring your active labor. 1 property is a start. 5 properties create substantial income. 20 properties create generational wealth. But traditional real estate isn't the only game. Commercial properties, storage units, short-term vacation rentals, and real estate investment trusts all offer different risk-reward profiles. The key is positive cash flow, not just appreciation speculation. A property that breaks even or costs you money every month is only valuable if it appreciates substantially, and that's gambling, not investing. Cash flow positive properties pay you to own them. Even if appreciation never happens, you're building wealth through monthly deposits and mortgage paydown. Stack enough cash flow positive properties, and you've built an income foundation that's nearly impossible to destroy. Digital brands and online businesses operate on different economics but similar principles. Build a content site in a profitable niche. Monetize through advertising, affiliates, sponsored content, and digital products. Optimize until it generates consistent monthly revenue. That brand is now an asset producing cash flow. Build another in a different niche, then another. Each one diversifies your income across different topics, platforms, and monetization methods. Some will succeed spectacularly, some will underperform. But the portfolio effect means your total income remains stable even when individual properties fluctuate. You're building the digital equivalent of a real estate portfolio, except the startup costs are a fraction and the scalability is exponential. Stock portfolios that focus on dividend-paying companies create reliable cash flow without requiring active management. Dividend aristocrats, companies that have increased dividends for 25 consecutive years, provide growing income streams that often outpace inflation. Build a portfolio generating 4% annual dividends, and a $500,000 investment produces $20,000 per year in passive income. Reinvest those dividends during accumulation years, and you're compounding your wealth. Take the distributions during retirement years, and you're living on the cash flow without touching principal. This is how old money stays wealthy across generations. They live on dividends and interest, never depleting the underlying capital. The most resilient portfolios combine uncorrelated assets. Real estate provides tangible value and inflation protection. Digital assets offer scalability and low capital requirements. Dividend stocks provide liquidity and historical stability. When real estate markets slow, digital assets might thrive. When tech stocks crash, real estate often holds firm. When both struggle, dividend-paying utilities and consumer staples typically maintain distributions. You're not trying to maximize returns in any single category. You're trying to optimize for consistent total cash flow across all economic conditions. This is defensive wealth building that prioritizes survival and steady growth over spectacular wins. The allocation strategy depends on your stage of wealth building. In your 20s and 30s, favor high-growth digital assets that require more time than capital. You have energy and learning capacity, but limited investment funds. Build the digital portfolio aggressively. In your 40s and 50s, balance digital assets with real estate as you accumulate capital for down payments. You're diversifying across both categories. In your 60s and beyond, shift toward dividend stocks and fully stabilized real estate that requires minimal management. You're prioritizing stability and predictability over growth. Your portfolio composition should evolve as your life circumstances and risk tolerance change. The mistake many people make is over-diversifying into things they don't understand. Owning a little bit of everything sounds safe, but if you don't understand the underlying assets, you can't make informed decisions during market chaos. Focus on 2 or 3 asset categories that you genuinely comprehend. Become expert enough to recognize value, opportunity, and risk. Build depth before seeking breadth. A portfolio of assets you deeply understand will always outperform a scattered collection of investments you bought because someone else recommended them. Knowledge is the ultimate risk management tool. The ultimate goal is building a portfolio that produces enough monthly cash flow to cover your lifestyle expenses. Once your assets generate more than you spend, you've achieved financial independence. Everything after that point is expansion, legacy building, or lifestyle upgrade. But the foundation is that moment when passive income exceeds active expenses. That's the threshold between working because you must and working because you choose. That's when money stops being a source of stress and becomes a tool for impact. That's the real wealth the cash flow portfolio delivers. Target 7 key points to take action. 1. Build a diversified portfolio across multiple asset categories to reduce vulnerability to single-sector downturns. 2. Prioritize real estate investments that generate positive monthly cash flow after all expenses. 3. Create multiple digital brands across different niches to diversify your online income sources. 4. Invest in dividend-paying stocks that provide reliable quarterly income without selling principal. 5. Combine uncorrelated assets so that when one category struggles, others provide stability. 6. Adjust portfolio allocation based on your life stage, favoring growth assets early and stable income later. 7. Focus on depth in 2 or 3 asset categories you genuinely understand rather than scattered surface-level diversification. Chapter 8. AI Assets: How Technology Can Build Wealth Faster Than Humans. We've crossed a threshold that most people haven't fully comprehended yet. For the first time in human history, you can have tireless workers that never sleep, never complain, never ask for raises, and continuously improve their capabilities. Artificial intelligence isn't just a tool anymore. It's a workforce. It's a business partner. It's a wealth multiplication engine that operates at speeds and scales impossible for human effort alone. The people who recognize this moment and learn to deploy AI as their asset-building team will create more wealth in the next 5 years than most people build in a lifetime. Think about what limits human wealth creation: time, energy, attention, knowledge, speed. You can only work so many hours. You can only learn so much. You can only be in one place at a time. You can only create so much content, write so much code, analyze so many data points, serve so many customers. These constraints have defined the ceiling of individual achievement for all of human history, but AI eliminates or dramatically reduces every single one of these limitations. It's not augmenting human capability, it's creating entirely new categories of possibility. Content creation was once the ultimate time-for-money trap. Write an article, get paid once. Create a video, spend hours in production. But AI can generate written content at speeds that would require a team of writers. It can create images, edit videos, compose music, and design graphics. The quality is rapidly approaching or exceeding average human output in many domains. Now, one person with AI tools can produce the content output of an entire creative agency. You're not replacing creativity, you're multiplying it. Your ideas remain the valuable input. AI becomes the execution engine that transforms those ideas into finished products at unprecedented speed. Business automation has entered a new dimension. Customer service chatbots that handle thousands of conversations simultaneously. AI assistants that manage scheduling, email responses, and routine tasks. Automated content schedulers that optimize posting times across platforms. Algorithms that analyze customer behavior and personalize marketing in real time. What used to require a team of employees now operates through AI systems that work continuously, without breaks, mistakes, or morale problems. The small business owner who learns to deploy these tools effectively can compete with companies 10 times their size. Data analysis and decision-making have become AI superpowers. Analyze thousands of market trends in seconds. Identify patterns across millions of data points that humans would never notice. Predict customer behavior with statistical precision. Optimize pricing strategies dynamically based on demand. Test hundreds of variations of marketing messages to find the highest converters. The information that would take a team of analysts weeks to process can be delivered in minutes with greater accuracy. You're making smarter decisions faster, which means you're adapting and capitalizing on opportunities before your competitors even recognize they exist. AI-powered products and services are the new frontier for asset creation. Build a mobile app that uses AI to solve a specific problem. Create a platform where AI provides personalized recommendations. Develop a tool where AI automates a tedious process. The AI is the product's core value, but you own the platform, the customer relationships, and the monetization structure. You've built an asset that leverages cutting-edge technology to deliver value that would be impossible through human labor alone. As AI capabilities improve, your product improves automatically without additional development cost. Your asset becomes more valuable over time with minimal ongoing investment. The investment implications are equally profound. AI algorithms that trade stocks based on complex pattern recognition, real estate valuation models that identify underpriced properties before they hit the market, automated portfolio rebalancing that optimizes tax efficiency and risk exposure, predictive analytics that spot emerging trends before they become obvious. You're not removing human judgment from investing, you're enhancing it with computational power that processes information at scales and speeds beyond human capability. The investors who combine human wisdom with AI analysis will consistently outperform those relying on either alone. The key to AI wealth building is understanding leverage. You're not just using AI to work faster, you're using AI to work at scales that fundamentally change the economics of your business. One person with AI tools can manage a portfolio of 20 rental properties through automated tenant screening, maintenance coordination, and financial reporting. One creator with AI assistance can produce daily content across 6 platforms, while most creators struggle with 1 post per week. One entrepreneur with AI systems can launch and test 10 business ideas in the time it used to take to launch one. The multiplication factor is what creates the wealth acceleration. But here's what separates winners from observers. Most people will marvel at AI capabilities and do nothing. Some will use AI to work slightly faster at their current job. A small percentage will recognize that AI isn't a productivity tool, it's a wealth multiplication platform. They'll deploy it to build assets, automate income streams, scale operations, and compress time to market for new ventures. They'll treat AI as their team, their workforce, their business development department. They'll ask not what can AI do, but what can I build with AI that creates lasting cash flow? That question changes everything. The wealth gap is about to expand dramatically, and AI is the dividing line. Those who learn to orchestrate AI systems will build asset portfolios at speeds that seem impossible to traditional entrepreneurs. Those who ignore or fear AI will watch their competitive advantages erode as AI-powered competitors operate faster, cheaper, and more efficiently. This isn't speculation about the distant future. This is the reality unfolding right now. The tools exist. The platforms are live. The only question is whether you're going to be the person using AI to build assets or the person watching others do it while wondering what happened. Target 7 key points to take action. 1. Recognize that AI removes traditional human limitations of time, energy, and scale in wealth creation. 2. Use AI content creation tools to multiply your creative output and build digital assets faster. 3. Implement AI automation systems to handle business operations that previously required human teams. 4. Leverage AI data analysis to make faster, smarter decisions based on pattern recognition at scale. 5. Build AI-powered products and services that provide value impossible through human labor alone. 6. Enhance investment decisions by combining human judgment with AI-powered analytics and predictions. 7. Treat AI as your wealth multiplication workforce rather than just a productivity enhancement tool. Chapter 9. Compounding Power, the Silent Wealth Accelerator. There's a force so powerful that it's been called the eighth wonder of the world, yet most people completely fail to harness it. It works invisibly in the background, turning modest beginnings into extraordinary outcomes. It's the reason the wealthy keep getting wealthier while everyone else struggles to keep pace. It doesn't require genius or luck. It requires patience, consistency, and understanding. Compounding is the silent accelerator that separates generational wealth from paycheck to paycheck survival. It's the difference between working harder and working smarter across time. The mathematics of compounding seem almost magical until you understand the mechanism. Invest $10,000 at 10% annual returns, and after 1 year, you have $11,000. Nothing spectacular. But that $11,000 now earns returns on the original $10,000 plus the $1,000 gain. Year 2 brings you to $12,100, still modest. But by year 10, you're at $25,937. By year 20, you're at $67,275. By year 30, you're at $174,494. Same 10% return, same original capital, but time transformed modest into magnificent. That's compounding. Early gains create the foundation for later gains, which create the foundation for even larger gains. But compounding isn't just about investment returns. It applies to every asset category and every wealth-building strategy. Rental properties that generate cash flow, which you use to buy more rental properties. Digital products that generate revenue, which you reinvest into creating more digital products. Business profits that fund expansion, which generates more profits, which fund more expansion. Each cycle builds on the previous cycle. The third rental property is easier to acquire than the first, because the first two are generating cash flow and building your creditworthiness. The 20th digital product launches faster than the 5th because you've refined your systems and built your audience. Compounding is geometric growth applied to asset accumulation. The cruel reality is that compounding rewards those who start early and punishes those who delay. Two people invest the same total amount. Person A invests $5,000 per year, starting at age 25 and stops at age 35, for a total investment of $50,000. Person B waits until 35 and invests $5,000 per year until 65, for a total investment of $150,000. At 65, with 8% returns, Person A has over $700,000. Person B has less than $600,000 despite investing 3 times as much total capital. The difference? Time. Compounding loves time. Every year of delay costs exponentially more than people realize. This is why the wealthy obsess over time horizons while everyone else focuses on quick wins. They're playing a different game with different rules. A 20% return over 6 months might sound impressive, but if you can't sustain it, you're gambling, not compounding. A consistent 8% return over 30 years destroys the flash-in-the-pan speculator every single time. Compounding requires the discipline to prioritize sustainable returns over spectacular claims. It requires the wisdom to measure success in decades, not quarters. It requires the patience to let time do the heavy lifting while you focus on consistency. Reinvestment is the fuel that accelerates compounding from impressive to extraordinary. Take the cash flow from your assets and immediately deploy it into new assets. The rental property income doesn't fund lifestyle inflation, it funds the next property down payment. The digital product revenue doesn't buy luxury items, it funds product development, marketing, and platform expansion. The dividend income doesn't get spent, it buys more dividend-paying stocks. Every dollar that gets reinvested rather than consumed multiplies the compounding effect. This is the sacrifice period that most people can't endure. They see cash flow and immediately convert it to consumption. The wealthy see cash flow and immediately convert it to more assets that produce more cash flow. System optimization creates compounding at the operational level. Every month you improve your processes, your efficiency increases. That efficiency creates more output with the same input. More output generates more revenue. More revenue funds better tools and systems. Better systems create even more efficiency. The entrepreneur who consistently improves their business by 1% per month creates a 34% improvement over a year. Most competitors make no improvements at all, wondering why they're falling further behind, despite working just as hard. Small, consistent optimizations compound into enormous competitive advantages over time. Knowledge and skill development compound exponentially when approached systematically. Learn one valuable skill deeply. It generates income. Use some of that income to learn a complementary skill. The two skills together create opportunities neither could generate alone. Add a third skill, and the combinations multiply. The marketer who learns copywriting can earn freelance income. Add sales skills, and they can close their own deals. Add product development, and they can build their own offers. Add automation, and they can scale without proportional effort increases. Each skill multiplies the value of previous skills. This is why lifelong learners dominate their fields. They're not just accumulating knowledge, they're compounding capabilities. The compound mindset transforms how you evaluate every decision. You stop asking, "What will this make me today?" and start asking, "What will this be worth in 10 years if I stay consistent?" You stop choosing between working harder and working smarter. You do both, knowing that smart effort today compounds into effortless results tomorrow. You stop resenting the boring consistency required for compounding. You embrace it as the price of exponential outcomes. The wealthy understand something profound. In the beginning, compounding feels slow, almost pointless. But there comes a magical inflection point where the growth becomes visible, then dramatic, then unstoppable. Your job is to persist long enough to reach that point. Target. 7 key points to take action. 1. Understand that compounding creates exponential growth where early gains become the foundation for larger future gains. 2. Start building assets immediately because time is the most critical factor in compounding success. 3. Prioritize consistent, sustainable returns over spectacular short-term gains that cannot be maintained. 4. Reinvest asset income into acquiring new assets rather than converting cash flow to immediate consumption. 5. Continuously optimize your systems by small percentages, knowing that improvements compound over time. 6. Develop complementary skills that multiply the value of each other rather than learning unrelated capabilities. 7. Adopt a decade-long time horizon for evaluating decisions rather than focusing on immediate returns.
Chapter 10. Your 10-year asset plan, from zero to forever wealth. You stand at a crossroads. Behind you is the path most people take, trading time for money until they're too old to work, hoping Social Security and modest savings will somehow be enough. Ahead of you is a different path, one that requires discipline, strategic thinking, and delayed gratification, but leads to a destination most people only dream about: financial freedom, true independence, wealth that sustains not just you, but generations to come. The distance between where you are and where you want to be isn't crossed in days or months. It's crossed through a systematic 10-year plan that transforms you from asset-less to asset-rich. Year 1 is about foundation and education. This is not the year you become wealthy. This is the year you become capable of becoming wealthy. Devour everything you can about asset classes, cash flow generation, and wealth psychology. Read the books, take the courses, study successful asset builders. Simultaneously, audit your current financial situation with brutal honesty. What's your actual cash flow? Where does every dollar go? What beliefs about money are holding you back? What skills do you have that could be monetized? Begin tracking every expense, not to punish yourself, but to understand the machine you're operating. Eliminate or reduce the highest paying expenses that bring the least value. Redirect that capital toward your first asset purchase or creation. The goal is ending year 1 with knowledge, clarity, and momentum. Year 2 is about creating your first real asset, not dabbling, not experimenting half-heartedly, committing to building or buying one asset that generates measurable monthly cash flow. Maybe it's a rental property you house hack by living in one unit while renting others. Maybe it's a digital product you create by packaging your professional expertise. Maybe it's a content platform you build by consistently publishing valuable information. Whatever you choose, the criteria is simple. It must produce income independent of your hourly effort. This first asset won't make you rich. It will probably generate a few $100s per month, but it proves the concept. It demonstrates that money can be made without selling your time. It shifts your identity from earner to owner. That psychological transformation is worth more than the cash flow itself. Year 3 is about optimization and expansion. You've built your first asset. Now make it better. Increase its income through better marketing, improved systems, or enhanced value delivery. Simultaneously, use the cash flow and the knowledge you've gained to build or buy asset number 2. This one should be in a different category than the first to begin your diversification. If your first asset was digital, make the second one real estate. If your first was real estate, make the second one digital. You're learning different games, understanding different systems, and reducing your vulnerability to any single market or platform. By the end of year 3, you should have 2 assets generating combined monthly income that covers at least one major expense category, maybe your housing or transportation costs. Years 4 through 6 are about acceleration and multiplication. This is when compounding starts becoming visible. Your first 2 assets are generating cash flow. You've refined your asset building process. You understand what works and what doesn't. Now you scale. Build or buy assets 3, 4, and 5. The pace quickens because you're no longer learning from zero. You have templates, systems, and experience. More importantly, you have cash flow from existing assets that can fund new asset acquisition. The rental income covers the down payment on the next property. The digital product revenue funds the creation of the next product. You're using your assets to buy more assets, which is the exact mechanism the wealthy use to accelerate their growth. By year 6, you should have 5 to 7 assets generating combined monthly income that covers multiple major expense categories. Years 7 and 8 are about team building and delegation. You've accumulated enough assets that managing them is becoming a meaningful time commitment. This is the transition point from solopreneur to business owner. Hire virtual assistants to handle routine tasks, contract specialists for technical work. Build systems that don't require your direct involvement. The goal is freeing your time so you can focus on strategy and new asset acquisition rather than daily operations. This is also when your assets should be generating enough combined income that you can afford to hire help without it feeling financially painful. These 2 years are about transitioning from I do everything to I oversee systems that do everything. It's uncomfortable because you're spending money to buy back time, but it's essential for reaching the next level. Year 9 is about portfolio refinement and risk management. You have a collection of assets. Some are performing spectacularly. Some are underperforming. Some require too much management for the return they generate. This is the year you prune, optimize, and potentially sell underperformers to reinvest capital into better opportunities. You're also stress testing your portfolio. What happens if one asset completely fails? Do the others sustain you? What happens if one entire category struggles? Does your diversification protect you? You're building resilience into your wealth structure, ensuring it can survive economic downturns, technological disruption, and personal life changes. By the end of year 9, your portfolio should be generating monthly cash flow that covers your basic living expenses. You're approaching or reaching financial independence. Year 10 is about legacy and lifestyle design. If you've executed the previous 9 years with discipline and intelligence, your assets are generating more monthly cash flow than your expenses require. You've crossed the threshold. You're financially independent. Now the questions change. Do you keep building assets to create generational wealth? Do you scale back and focus on experiences and relationships? Do you start teaching others the path you've walked? Do you use your resources to create impact beyond yourself? The beautiful answer is you get to choose, because money is no longer making the decision for you. You're working because you want to, on projects you care about, with people you respect. That's what forever wealth actually means. Not infinite money, but infinite choice. The plan sounds simple because it is, but simple doesn't mean easy. Most people will read this and do nothing. Some will start and quit after the first setback. A small percentage will persist through the uncomfortable early years when results feel insignificant. Those few will reach year 10 and look back in amazement at the transformation. The person you are today cannot fully comprehend the person you'll become through this process, the skills you'll develop, the confidence you'll build, the freedom you'll create. But that future person exists only if you start today, commit completely, and refuse to quit when it gets hard. The path is laid out. The only question is whether you'll walk it. Target 7 key points to take action. 1. Dedicate year 1 to financial education, expense auditing, and developing asset-building capabilities. 2. Create your first cash flow generating asset in year 2, prioritizing proof of concept over maximum profit. 3. Optimize your first asset and build a second in a different category during year 3 for diversification. 4. Accelerate asset acquisition in years 4 through 6 using existing cash flow to fund new purchases. 5. Transition from doing everything yourself to building teams and systems in years 7 and 8. 6. Refine your portfolio in year 9 by eliminating underperformers and stress testing your diversification. 7. Reach financial independence by year 10 where asset income exceeds expenses, enabling complete lifestyle choice.